Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the March 21st, 2023 podcast. We have a great episode today for any real estate developer planning to preserve an historic building. Now, developers of historic buildings know that preserving the architectural integrity and historic character of a property adds significant additional development costs, which in turn creates or expands a financing gap. This is where the federal rehabilitation tax credit has been instrumental in making historic preservation projects more feasible. The historic tax credit is calculated as 20% of qualified rehabilitation expenditures, and it's claimed ratably over 5 years. Now, generally, only amounts that are properly capitalized in connection with historic rehabilitation qualify for the historic credit, which means furniture, fixtures, and equipment, site work, acquisition, and larger costs do not qualify. Now, there are certain other conditions that must be met in order to claim the credit. First, the property must be used for business or other income-producing purposes. It can't be a personal use asset. Second, a substantial amount must be spent rehabilitating the historic building. Third, the building needs to be certified as an historic structure by the National Park Service. And fourth, the rehabilitation work itself needs to be certified as meeting the Secretary of the Interior standards for renovation or rehabilitation. Now, if you think your historic rehabilitation project can qualify under these criteria, then keep listening, because we're going to talk about additional sources of financing that can be raised for your project beyond the federal historic tax credit. We'll discuss each subsidy as well as the main benefits, opportunities, and challenges that come with layering these additional equity sources into historic tax credit development. Now, joining me in today's podcast is my partner, Warren Sebra. He's based in Novogoradac's Portland, Oregon office. Warren has vast experience serving clients in affordable housing, community development, and historic rehabilitation. He is a frequent speaker at tax credit conferences, and he's a regular contributor to the Novogradac Journal of Tax Credits. He also has the distinction of being our first Novogradac Tax Credit Tuesday podcast guest to appear on camera on our YouTube channel. I'm happy to have him back on the podcast today. If you're ready, let's get started. So Warren, welcome back to Tax Credit Tuesday.
Thanks, Mike. Glad to be here.
So let's jump right in. Let's get right to it. So what are some of the most common sources of equity and other financing that developers can layer into an historic tax credit project? And but before you say it, please list them in the order of how commonly they're used in connection with the historic tax credit. And then I want to do a deeper dive into each one.
Yeah. As I work with developers on structuring and forecasting historic tax credit projects, I've seen developers often utilize several credits or incentives that's layered in with the project. And so kind of the order which I've seen, it doesn't mean that it's like the end all be all is the affordable housing credit, state historic tax credits, new markets tax credits, and solar, and then opportunity zones. And with solar, maybe now the 45L credit. When I look at the historic tax credit, sometimes I refer to my own brand as a friendly tax credit, because the way that the code is written and the way it's structured can fit nicely with a lot of other credits that are out there for community development.
That's a good way to frame it, that it works well, it plays well with others.
Yeah.
So that's a pretty comprehensive list. So let's start with the low business tax credit. It is the tax credit that provides the deepest subsidy of any source of any tax credit that I'm aware of, which makes it a good place to start. Now, for our listeners, they may not be that familiar with the low business tax credit. So if you could briefly explain the difference between the 9% and 4% low business tax credit. I'll assume that the listeners know that the low business tax credit is a credit designed to subsidize the development and renovation and operation of affordable housing properties, basically properties that are serving lower income tenants at restricted rents. So if you could talk about the difference between the 9% low business tax credit and the 4% and how they affect the amount of equity raised, and then maybe some hypothetical examples of typical size transactions.
Thanks, Mike. And if our listeners who are familiar with the historic tax credit, there used to be two types, the 20% and 10%. 10% has gone away. Now we're left with the 20%. Like in affordable housing, there's a 9% credit and a 4%. And the end result is you still get a affordable housing credit, but there are different subsidies depending upon the credit. The 9% is a direct allocation from tax credit state agency that allocates that to developers who apply to it. And like you said, it is the deepest subsidy out there. I mean, 9%. So if you have a, $10 million project and you are able to claim those credits over 10 years, 9% of your credits equal to $900,000 per year. It's because of that amount, it can be a very deep subsidy. And you have to apply for this, and it is an allocation, and it's highly competitive. It's the 9% has always been highly competitive. Obviously, in the last few years, it's going to be more competitive given the scarcity of resources for affordable housing throughout our country. So the other LIHTC credit, it's the same in terms of how you claim it, but there's a 4%, and that is also applied for the state, and it's becoming a scarce resource to have tax-exempt bonds. So you have to apply for a tax-exempt bond award, and if you receive that award, you receive an amount of tax-exempt bonds, and then that allows you to claim the credit at 4%. So like my example, if you had $10 million in eligible costs, it would generate $900,000 annually for 10 years of credits. On the 4%, it'd be $400,000 over 10 years. And it's still a pretty significant subsidy, not as significant as 9%, but it can really help fill a gap of a historic tax credit project. If you look at 9%, you may, on average, could fill about 60% of your capital stack, and a 4%, maybe between 30 and 35 of your capital stack. And so if you cap that with historic tax credits equity, it can really help a project that is in need of some financing to get the project done.
So thank you for that. I think that's a good overview of the 9% credit and the 4% credit. And just to layer in a few more nuances, as you were kind of explaining the 9% for the allocated credit to state agency and the 4% that goes with private activity bond financing. If you do go down the 9% credit, the allocated credit route, the 9% credit is what's allowed for the renovation costs. And the 4% credit is what's allowed for the acquisition costs of a property. So that's just an additional nuance. And there's lots of other nuances there. And that's what keeps Warren busy when he's combining long-term tax credits with historic tax credits, trying to decide what costs are eligible for which tax credit and which costs are eligible for both. But maybe we can dig a little bit deeper on the long-term tax credit when it's combined with the historic credit. And you could share with the listeners what you think of as some of the important considerations when you're combining the two. Maybe just give a handful. There's a lot of considerations, a lot of significant considerations, but if you could just share a number of them, just to let our listeners know a bit about it. And obviously they can reach out to you with more specific and detailed questions.
Thanks, Mike. I like how you point out that 4% can help finance the acquisition. As you mentioned, on the historic side, no acquisition costs qualify for historic. So that's a very important thing to remember. One thing I think about and I talk to developers about when they're trying to consider this is using multiple tax incentives or credits is the historic tax credit. There's no form application to receive the credit. Obviously, you have to apply to have a historic tax credit building if it's not already registered and to have your rehab approved by the National Park Service. As we know about, but you don't have to apply to an agency to receive the credit. If you have a historic tax credit building, qualify costs, get the credit. Whereas LIHTC, there's a significant application on the 9% side and the 4%. 9% typically has been scored and is based on point scoring to receive an award. 4% and historically have not been that way, but they're becoming that way. Very competitive, especially states like California, Washington and Oregon states I work out is going to be very competitive to do that. And so a very scarce resource. So you have to factor in, not only do you have to get your historic tax credit rehab approved, you have to apply for this credit. There could just be some lead time. Sometimes it's hard to sync up your development with receiving an award of these credits. And that I think can be challenging, especially if you're not familiar with, applying for incentives and grants. That could be a challenging to have your organization learn how to do that. Of course, we're happy to help with those type of applications. We do that all the time. And I've helped my clients as well apply for those credits in Oregon and California. And so if that's something you need, we're happy to help with that. One thing to also remember is that under the affordable housing program, if you use historic tax credits there's a basis reduction to your affordable housing. So you have to reduce your eligible basis by the amount of tax credits you claim for historics, because that could be challenging to kind of figure out how to calculate and know how much equity you're projecting out for your financing. So that's something to keep aware of.
So I'm glad you pointed out the reduction of eligible basis, because it's an interesting nuance in structuring long-term living tax credits with historics, because there's a couple of ways to do it, as you know. If you have the same investor that fund both the historic and long-term tax credits, then you'll have this basis reduction. And if you're using 9% credits, you're allocating the dollar amount of the 9% credit. A lot of transactions with 9% credits have, quote, extra basis, in the sense that their actual costs would generate more credits, but you're limited to the award you get from the state. And in those situations, a reduction in eligible basis, because of the historic credit, doesn't really cost you any 9% credits. It costs you some depreciation, but that's not a significant issue. However, if you're financing with 4% bonds, if you're using 4% credits by virtue of having private activity bonds, then you generally won't have a cap on the credits you can claim. And if you do have to reduce your eligible basis by the historic credit, then you will end up losing some 4% tax credits, which can lead many developers to say, well, rather than have the same investor and lose some state long-term tax credits, 4% credits, I'm going to bring in two different investors and use a master lease structure, and as a consequence, avoid the basis reduction. Which this is not a 202 course in combining historic credits with long-term tax credits and a lease structure. I will include the podcast that we did recently on the pass-through lease structure versus direct equity structure for historic tax credits. For listeners that are thinking of doing long-term tax credits, you should listen to that podcast and reach out to Warren so you can discuss the various structuring aspects of combining LIHTC with historics. I don't know, Warren, if you wanted to add anything to that, or we can move on to state historic tax credits.
No, I think that's a really good observation. And especially when you're doing the lease pass through, that typically in LIHTC, you will see a separate investor on the LIHTC side and historic. That sometimes have some complications getting two investors together. Another more challenge to that is when you're doing multiple investors, just because they might have different requests and different things they want out of the project. And so that could be some time consuming and learning to work with two investors. But if you're going into this, you're probably going to be doing multiple incentives if you're wanting to combine. So you might have to start front knowing that you're going to be working with multiple investors.
Where you're being generous and you say there could be some applications.
There will be, right?
There will be some. The question is how significant, but obviously it's definitely more involved. It's done all the time. And while it's more complex, it's very achievable. And that's why you work with experts who understand the complexity, experts like yourself. So let's turn now to state historic tax credits. That was the next equity source on your list, but it's really, long-term tax credits, state historic tax credits. You see both of those in a lot of transactions. And the interesting thing about the state historic credit is, by virtue of the fact that it's a state historic tax credit, that every state can modify it and change it in their own unique ways. The federal long-term tax credit is obviously a federal incentive. So like this federal historic credit is, so it has federal rules with additional modifications at the state level. I should note that there is also, many states have a state long-term tax credit, and we're really not going to talk about the state long-term tax credit in this podcast. But just know that while we're talking about a number of sources that can be matched with historic tax credits, there's even more than what we have time to talk about on the podcast. But let's get back to state historic tax credit. Each state that has the historic tax credit can run it differently, and it can have different variations. So maybe, Warren, you could just talk about some of the characteristics of the various state historic tax credits are out there, just so a developer is generally aware, knowing that the developer will have to look in their particular state that they're developing a property to see what the unique aspects are of that state historic tax credit.
Yes. Thanks, Mike. And thanks for pointing out that there's other state incentives that we can talk about, but we'll save that for another day. The state historics can be a great source for equity. And I think you mentioned this, Mike. It's really important to know your state. because a lot of the states have very different nuances. I remember working on a project, I won't name the state, and we had state historic tax credits and legislator turn it off, meaning that they say, okay, no more. And so you have to really know what's going on in that state. And some of the characteristics that you see is oftentimes there's caps per project and per year or in total, because legislation might say, okay, we will do this, but we're only going to have $20 million, whatever the number is. And it could be capped on per project. But another very key thing to understand is what type of credit it is. By what I mean by that, is it going to be a certificated credit or allocated credit? An allocated credit, you have to have the partner into the partnership and they're allocated to the partner. Or or certificated credit, the developer can take the certificate they received from the state and sell it to anyone that has, I would say anyone by law, who's allowed to use a credit in that state. And the important thing to note there is when the developer sells that, they will have, it's considered a gain when you sell that. So whatever the amount you sell it for, you base it zero, that will be your gain. So that's important to understand that there will be that gain factor. But the certificated credit does allow for significant more equity into the project than an allocated. The allocated credit, the state investor is not getting a deduction on their state credit, the state taxes in that state. But the certificated credit, they're getting a deduction of the state taxes paid and also receiving the credit. So that's an important nuance, and that's why you'll get a little more equity. So it used to be that not a lot of states had certificated credits. The trend is moving forward to more states having certificated credits. And when laws are being passed, a lot of people are in the forefront and say, hey, if you're going to do this, let's do it correctly to have this and wield the most impact for projects. And so that's kind of the most important thing to know is what type it is between allocated and certificated.
Yeah, I totally agree with you in terms of the allocated versus certificated. In some states, you have the option of having it,
Right.
as you know, in terms of transferring it or bringing an investor and allocating it to the investor. And it is one of the interesting aspects of state tax credits just in general is it's viewed as property as opposed to the federal tax credits aren't generally considered property. There's something that flows to the owner. And I would note that I know you spend a lot of time, but I'll know for our listeners, analyzing what the best way is for a transferable credit to transfer it. And if you're going to have an allocated credit, the best way to structure the investor coming into the transaction. Oftentimes there's multiple investors, one for the state, one for the federal, and then oftentimes it will be the same. And I'm glad that you pointed out the taxable nature of the transferable credit such that the partnership itself would have income, which obviously can generate a tax liability but there's different structures that someone use to get that. And then as you pointed out, the buyer of the credit does get to recover their basis all at once when they transfer. When they buy the credit and then when they use the credit, they get the full base at the time. That's why they can pay more for it at that time. Whereas when you're investing in equity, the investor puts the dollars in now, gets the credit, but doesn't get to deduct their equity investment until they leave the investment, which could be 10 years, 15 years later, which substantially reduces the benefit there. Anyways, there's a lot of those sort of calculations, which will be a theme, which is a theme of this podcast, is you end up having to run lots of numbers in order to assess, which structure is the best. And they're iterative in the sense that as you're doing one adjustment, say on the state historic tax credit, that could have implications for the federal. And if we're bringing in lugs and tax credits as well, there's these various complexities. And I know you spend a lot of your time, Warren, advising clients as we're trying to assess the various interactions. Anything else you want to say on state historic tax credits, or should we move on to new markets?
I was just going to say it is in my mind, so I'll probably just say it so it's out of my mind. Some credits can be refundable. So that's actually another plus. So again, remember just to look at the nuances of the state historics and to know what your state has and what it offers.
Now, I'm glad you pointed out the refundability feature, because there really are three ways to, if you will. You could do it through, allocations and equity. You could do it through just a cash payment for transferability, or wait and get it refunded. So number 3 on your list of equity sources was the new markets tax credit. And the new market tax credit is a federal incentive to encourage private investment in distressed communities. The new market tax credit is run by the Community Development Finance Institutions Fund, or CDFI fund. That's the entity that allocates the credit to awardees. and then administers their use of the credit. The awardees are specialized financial intermediaries called community development entities, or CDEs. And they're the entities that have applied to the CDFI fund for the right to issue equity eligible for the credit. And it's super competitive, much like 9% credits are competitive and 4% bonds, or I should say productivity bonds in many states are now competitive. And then these CDEs use their authority to issue qualifying equity to raise money from investors, with investors getting tax credits for investing in the CDE. So maybe you could just talk a bit about, how these CDEs make loans to businesses and low-income communities, and how an historic tax credit development, or a historic tax credit developer can reach out to CDEs and get some of this below market rate financing.
Yeah, great. I think it's important to know that, as you mentioned, the new market tax credit will come down or come to the project in the form of a loan. And so it's not going to be equity into the project, it will be a loan, but it'll be a very favorable rates, below market rates, a lot of different things. And one thing that I just want to make sure before we dive into how they receive it is it's highly competitive, and also receiving allocation oftentimes is your development has to be in line with the application awards. And so that can be very challenging sometimes. Like, I have a project, but it's not ready for 18 months. But since it's so competitive, and the Treasury, the CDFI fund, incentivizes CDs to deploy their resources soon. So a lot of it's timing, and you can have a great project, and CDs can be very interesting in your project that say, we got to deploy within 6 months. If you're not ready, please ask us in another year and a half when you're ready. And so you have to have relationships with CDEs, because CDEs, I don't say it's a tight knit community, but there's relatively to local housing, there's not a lot of CDs out there, and there's not a lot of CDs out there that have allocation, because it's a very scarce resource. So you have to have some ways to get to know CDs, whether it's through your contacts at going to our conferences and meeting people, or through other resources like a consultant, a person that will put projects together. It's hard to go out on your own sometimes to find these allocations, but when you do find the allocation, it can be very rewarding and can provide subsidies. It's not as deep as the affordable housing or state credits, but it can still provide anywhere between 25-30% of your capital stack in the form of a below market rate loan. And people say, well, how much loan can I receive? That really depends upon the allocation of the CD, because you might receive 30 to 50 million an allocation. And typically they don't spend it all in one project. They divide it up between multiple projects. I mean, I've seen anywhere between $2 million loans up to 10, 15, $20 million loans. And so that's something to think about, is you may not be getting 50 to 60, $70 million. Whereas in affordable housing, you definitely can get that much equity depending on the project size. And so I hate to use the word shallow because that has negative contents, but it's not as a deep subsidy as the affordable housing tax credit. And so if you're sizing your deal, you can't necessarily say, hey, I'm going to get 7 million in a loan. It really does vary upon your CDE. And oftentimes you may be using 1 or 2 or 3 CDs in your deal if you can do that.
So thank you for that. And, we kind of based our answer here on the CDE making a loan, which is the typical way in which a CDE will finance businesses in low-income communities. But it is possible to get a double up, if you will, and get a CDE to use their allocation to make equity investments, and even equity investments that are on the same dollars that are being invested for the historic credit. That's not something that we see all that often. It's a little bit more boutique-y, but it is an option out there. So I thought it was important to mention that, Warren, since there's probably a listener right now going, or was saying that before until I made that caveat, saying, but you can actually use it on the same dollars to be able to raise a little bit more equity, and that it's true, but there's a number of hurdles to go through. And how often would you say you see that? Rarely?
I would say
And
rarely. I don't see it too often, because I think we have McDellans, the new market tax credit structure is complex in itself. And when you layer in historics, it becomes that much more complex. And, what you were talking about can also layer into more complexities.
And there's some equity control issues that deal with capture and all the rest that we don't have time to go into here.
Right.
But beyond that equity tangent that I went on, when I think about it as a loan, what are some of the other sort of considerations or challenges you see using new markets with the historic tax credit?
Yeah, and I briefly mentioned it. Structuring is challenging because more likely than not, you're going to use a master lease structure to separate out the credits. The new markets will come through a leverage loan to the CDE to the quality B, and the historics will go from the master tenant over to the landlord. And just right now, we could be confused by just those few words because it's incredibly complex. We have lots of triangles and squares, a flow chart in our forecasting that shows this, but it can be challenging. And there's a lot of, in the historic tax credits, there's a revenue proc that talks about how you have to structure this. It has to be separately negotiated in order to kind of sustain the historic tax credit as the structure as a whole structure under partnership law. And so there has to be something negotiated because that you have two investors, new markets and historic tax credit investor, almost always when you have historic new markets deal. So that can also, we talked about LIHTC, more, more entities. Cause also remember when you're doing the new markets, you have a CDE as well. So you have three entities to kind of give information to: the CDE, new markets investor, and the historic investor. And that could be challenging because if you're not in the world of having an investor in your project, dealing with three different people that want financial information or are involved in forecasting, it could be a challenge thing, but it can be done because these deals are done a lot. Historics, new markets are partnered quite a bit, not as often as, LIHTC and state historic, but it can be done. And like I said, the master lease structure generally is the structure you see, and that allows the equity portion to go in terms over the bulk be as a loan or as an equity investment or a prepaid lease structure. Those all are things that can be used to bring over because essentially when you do a pass-through election, the credits are passed through to the master tenant, then allocated up to the historic tax credit investor. So those can be complicated and the cash flows can get a little hairy. That's why you need someone there to forecast and to work it out. I know typically when I do these, before an investor comes down the pipe, I work with my client to understand the cash flows and how the sources of cash, because that could be very challenging thing because it's different than a lot of other typical real estate transactions.
So thank you for that. And we can spend a lot of time talking about that. And we'll link to other podcasts that we've had on both new market tax credits as well as on historic tax credits, most particularly the sort of straight equity transactions for historic tax credits and the lead pass through. So let's move on to another area where we have lots of podcasts on.
Hey, Mike, if I can just interject one thing.
Please.
One thing I forgot that's important is location with new markets. Is new markets, you have to be located in a low-income community. And so that's very important. So you might have a historic tax credit deal. It's great, but it's not located in a low-income community. It won't qualify. So I just wanted to mention that one thing.
No, I appreciate you mentioning that. And every time we mention something, we have to mention something else. So, because as you point out, new markets, the general rule is you have to be located in a low-income community. However, as you know, there can also be targeted populations where not in a low-income community, but you're serving a targeted population, then you can qualify. And yes, we have a podcast on that too, which we'll link to. So it's, we're definitely making it quite evident to the listeners that as you're layering in additional incentives, there's a number of interactions and additional rules that you need to be mindful of. And it's important not to kind of self-select yourself out of particular subsidies. It's important to talk to someone who is knowledgeable about the subsidies, because if you don't think you're eligible, it turns out you might be. And new market tax credit, low-income community location versus target populations is a classic example of that. So I'm glad you interrupted me and discussed the location because I kept referencing it, but you really highlighted it, which is important. So let's turn now to solar or 45 CAPL, a couple of credits dealing with energy generation and energy efficiency. So if you could give an overview on how solar tax credits can be brought to historic properties, as well as how the 45 CAPL credit can generate some additional equity.
Yeah. And I think it's important to understand when you're dealing with historic tax credit, your rehab has to be approved by the national parks. And so national parks has written a paper saying, hey, yeah, solar does work. But, the site tests, like here is like, generally it's not written in the code, it's not written in the rules, but generally what we hear and what we see is that if you can see the solar from the ground, then you probably won't get approved by the national parks.
Right, the sidewalk test. I can't.
Sidewalk
The
test.
sidewalk.
Thank you. Sidewalk test. So just keep that in mind there. But like I said, the national parks has got a paper saying, yes, it does work, but that is because the national parks wants to make sure we restore the buildings to the original intent and make it look historic. And so sometimes that's in conflict with maybe a renewable energy source. And so there's people have heard a lot about IRA, that the tax law that was signed about, and a lot of it had renewable energy. And the most, thing that we hear a lot about and is the 30% solar. Actually, I took advantage of that and put solar in my house this year because it actually was their cost. So it's really is having an impact out there in the world. And a lot of people are calling me about, hey, how do I do this with LIHTC? How do I do the historics? It's becoming more and more common because not only is 30%, but there's also other incentives so we can boost that up higher. And we can do a podcast in itself about this. I'm sure there is out there.
There is.
How to it could go from 30% to 7%. And just real quick, if it's in the affordable housing and if it's with prevailing wages, stuff like that, it can increase that incentive. So I think it's really important to kind of understand that nuance because you might hear, hey, I can get 70%, but the standard base is 30% on solar, and it goes up from there to meet those qualifications. And it could be hard to meet those qualifications. So just bear in mind, start with 30%, and if you can layer in additional percentage, that'd be great. And then one thing that was done in the IRA is the 45L credit was extended to 2032. Oftentimes we heard a lot about the 45L credit, but it gets extended too late to be utilized. And now since it's been extended out to 2032, it can really be utilized. And that can range from $500 per dwelling unit and up to $5,000. And so it's also key to remember there's some really nuances there to meet like prevailing wages one and being certified under the Department of Energy and Energy Star. So you have to actually get a certification to use the 45L credits. But I imagine these will become more popular. They're not a huge, deep subsidy, but nevertheless, it could be an additional subsidy and that you have in your property. I think one thing to remember is oftentimes what I see in LIHTC development, also in historic development, is 45L and solar is always added at the end. Oh yeah, let's do this. It's not contemplated at the beginning. And then you have to go back to your investor to say, hey, we want to do this. Are you willing to pay for that? And this whole nother negotiation. So it's important to kind of bring all these incentives up front, especially the more shallow ones where you're kind of thinking about and not sure if it's going to work until later on in the development phase. So it's important to kind of think about that and, offer that to your investor up front so they're aware. So that way you're maximizing the amount of equity that's coming out.
Yeah, I think it's a good point about the 45 CAPL credit now being, having been extended for 10 years, so you can include it in your pro formas.
Right.
Which was hard to do before and get investors to commit to them. You could do it and have some optionality to it, but now it's something you'd expect to see in most developments. And then on the solar credit, that is to me always an interesting subsidy because beyond the credit itself that you could generate, the sort of 30% range or with the adders to maybe 40% more to 70%. And then there's only a 50% basis adjustment. So you end up getting some additional value for the depreciation, but it also, generates power. So it, lowers some of your operating expenses. And as a consequence of lowering some operating expenses can actually allow you to raise more hard debt. So there are, a little bit more complexities when you're doing the financial modeling for solar credits. But what are some of the other considerations that you would think the developer should be aware of with the solar tax credit or 45 CAPL?
I think you briefly mentioned it. I said I briefly mentioned about the visibility test. And I think there is some consideration in terms of if it's worth it, right? Because it's not a very deep thing. And so that I think is something to consider. Should I bother with this? Sometimes the solar panels are hard to get right now. I've had a lot of people in my development waiting on the solar panels because it's very popular and it's very in demand. So that's also consideration is like, hey, can I actually get these installed when I want get them installed? So that's a real consideration.
So now let's move on to the sixth item, the last item in your list of additional sources of financing. And that is opportunity zones. I should say properties located in opportunity zones can be eligible for investors that are seeking to invest in opportunity zones. And as many of our listeners know, the Opportunity Zones Incentive was created in 2017, and it's certainly the most flexible in the sense that it's not limited to a specific property type. It is limited to locations. That's actually the property itself has to be in an opportunity zone. So as I noted, roughly half the historic properties are in an opportunity zone. That's one rough estimate. But if you're wondering when your historic building is indeed located in an opportunity zone, you can simply go to our website at www.novoco.com and navigate to our Opportunity Zones Resource Center. And we have a free opportunity zone mapping tool. You can enter the address of your building and you can see whether or not it's in an opportunity zone. And I will include a link to the mapping tool in our show notes. But let's get back to asking you a question, Warren. Building on my basic overview of opportunity zones, what are some reasons why developers might want to consider pursuing an opportunity zones investment?
Yeah, thanks, Mike. I think before I delve into that, I just wanted to make sure, because I get this often, you have to have a gain, right? That's the key thing. You can't just invest. It has to be a gain that you're investing. I know that is still continuing to be a hurdle that people have to understand, because unlike 1031 exchanges, if you sell your real estate, you can do a 1031 exchange. Same here. You have to have a gain. You can't just have money to invest. It has to be an investable gain. So that's one key thing. And so why would they consider this? I think it could attract additional equity, maybe from a traditional tax credit investor or economic investor. And it could increase the yield that's already our LIHTC or historic investor is already aware of. It can help it increase that yield. And so that's one thing that you have to, and I appreciate you mentioning location was a key, because remember, we talked about new markets, location was also a key, but in new markets, there was another way.
Like target populations,
right? To get around it. With opportunity zones is not, has to be in the right location, right? So that's a key important thing you mentioned, is has to be in the right location. So if you're not in one, then you can't use this incentive. And it's more of an incentive than a tax credit, as you talked about, that will increase the amount of equity and that you could receive because you're increasing the yield to your investor.
Right. It's important for listeners to know that from the standpoint of a developer using it to raise additional equity, the equity could come in either from the investor who's also investing in the historics. So it's the same investor who's investing in the historics, but also interested in the opportunity zone benefits. Or it could be a sidecar type investment where it's an opportunity fund focused on, investing in your area, and they make a sidecar investment with the historic. And then you get back into is it a straight up structure, or do you do a master lease? And there's different touches there, which once again, that's a 202 course, not this basics. But I also wanted to point out, and I know you've worked with investors as well, or developers, I should say, that it's not something that a developer should just be thinking about, can I raise money from somebody else with this? Developer themselves might look at it and say, I myself have some capital gains that I've recognized. And before I buy the historic property, or even after I bought it, I developed some new structures such that I can invest those gains in my own opportunity fund that I form myself and use that to buy the property or to invest in the property, so that the developer themselves can get some additional tax benefits for doing their historic development. And given the challenges of developments, and given the fact that there's financing gaps, and oftentimes developers aren't able to generate the cash development fees that they would from a typical, non-historic development, the benefits of being an opportunity zone and layering in the opportunity zone benefit, can oftentimes be the difference between a developer deciding to move forward with an investment or not. So I just wanted to tee that option for developers. Maybe you could discuss any other comments you have on that, or other challenges for using opportunity zones or with the historic tax credits.
Yeah, thanks for pointing that out. I certainly work with developers creating their own funds to defer their gains. It's important to realize it's not just for investors, it could be for a developer who has gain, who sells the real estate here or there. One thing I want to mention out, the initial deferral in the law was passed was 7 years, and now I think we're down to 3 years. And so there is a sunset provision for the initial deferral unless it gets extended by Congress. So there are a time crunch here about the next 3 years. I think you did the math right? 3 more years
Yes.
on that. So keep in mind that. But even if you get the 3 years, investment before the 3 years, you still have the long-term deferral, as you mentioned. So I think that I field a lot of questions about opportunity zones. Sometimes it's more so than the other things because it's new. And I think, like I mentioned this before, sometimes it's really hard to find that gain and match that gain up with the project that is being developed, right? Because if the gain, you have to have that gain. If it's not a gain, it's not aligned, especially if you're in your qualified investment fund. If you're trying to match up multiple investors, it's even harder to find that gain because you're dealing with multiple entities. So that can be a challenge to do that. And that's one of the challenges, but it can be done. We do see funds that find multiple investors and have utilized this incentive to help enhance the equity that comes down to the end to the developer.
And that's important to point out the various timing rules and having the gain. And my general rule of thumb there is, if you have the gain, you can form the fund, and there's ways in which you can develop, create a bit of time to make your investment. But, I guess I would just say they can reach out to you with additional questions on how to structure that. So we've covered 6 sources of equity that can help close the gap for historic preservation projects. We talked about federal local living tax credits, noting that there's really a 7th state local living tax credits. And it's really more than 7 because there's a number of other subsidies that we don't have time to talk about. There are state historic tax credits. They can come in a couple of forms: transferable or equity or fundability. New market tax credits. And just as there's federal, we talked about the federal new market tax credit. We didn't talk about state new market tax credits or state credits that are similar to federal new market tax credits. We talked about solar, and then there's also various state potential benefits for solar. We talked about 45 Cap L, and we've talked about opportunity zones. So having spoken about all of those and touched upon even more, what do you advise as next steps for developers who are listening to this podcast and thinking, I need to know more about some of these options?
Well, call one of us, call me. I'm happy to talk to people about this. It's something that not only is my career, but I've developed a passion and love for seeing communities being changed by historic tax credits and other incentives we've talked about. And also our website is a great resource, our conferences, all the above. I know in April, we're having our affordable housing conference in San Francisco. In the fall time, we'll have our historic tax credit conference. So there's plenty of resources out there that our firm has, and some of them are free. Like I said, like our mapping tool for new markets, our mapping tool for opportunity zones, and that's a free service you can find right on our website, or contact me. Happy to talk to you about this and see where your project can go.
Thank you for that, Warren. Appreciate you being on the podcast today. Please do stick around for our off mic section, where we get to ask you some fun off topic questions and get some words of wisdom from you. For our listeners, here's a preview of next week's episode, which will be a must list of all public housing authorities, as well as developers and financing companies that work with public housing authorities. So what are we going to talk about? We're going to discuss repositioning options for public housing authorities with respect to their public housing stock. This is a pretty timely topic because we at Novogradac have been fielding many inquiries lately from public housing authorities that are interested in converting their public housing stock through the Rental Assistance Demonstration, or RAD program. You might be thinking, why this sudden uptick in RAD inquiries? Well, public housing authorities rely on annual funding, operating costs, and capital needs to maintain their public housing stock. These funding levels are subject to congressional approval each year. While public housing authorities are growing increasingly concerned as to whether HUD funding for public housing will be sufficient in future years. Hence, this is an opportune time for public housing authorities to think about how they can be proactive and best position their assets for the future. Joining me in the podcast will be my partner, Rich Larson, and we'll talk about some of the common repositioning options for public housing authorities, as well as the benefits and challenges of each of the repositioning options. If you have any RAD-related questions that you'd suggest we address in next week's episode, please post them on Twitter and tag me using my handle @Novogradac. You can also send me your questions through CPAs at Novoco.com. And now I'm pleased to reach our off mic section. It's a fun way for listeners to get some tips and recommendations from our guests. Also a way for me to get tips and recommendations from our guests. So I only have 2 questions for you, Warren. Oftentimes I have 3. The first one is, what's the best piece of professional advice you've ever heard? And I say best piece, but you could just say, what's a notable piece? Whenever I say best, it's like, okay, now I got to really sit back and think hard. What the best of the best, if you will, and how do you define best? So if you can just share with me an important piece of professional advice that you've heard.
It's kind of like ranking the all-time NBA basketball players. Is it Jordan or LeBron, right? Each generation.
Children. I won't ask you for that.
Yes, exactly. Or children. But, one thing that someone told me is early on, because I worked with Novogradac my whole professional, but someone in this kind of relates to kind of professional service providers. And I've used this and it's worked often. And it's always pick up your phone when your clients are calling. And I can't tell you how much my clients have appreciated, or I picked up a phone call and someone said, "Hey, you picked up." I'm so surprised. I'm like, "Oh, I'm here to serve you. So what do you need?" Right. And it's something so simple, but since people are not used to it because they expect to get a voicemail or get called back 2 or 3 days later, it can have a profound effect on your relationship with clients or with other people in your network. So I always try to pick up the phone call when it's ringing. As soon as it's not a spam call, that I pick it up. So that's the thing I have.
No, I love your focus on communication and picking up the phone, and even the opposite, call your clients, call them. And the one time I always find interesting with that is sometimes when, you're delayed or, project's running late or something, there could be a tendency to not want to talk to the client until it's done. It's like, no, just let the clients communicate with you and you want to communicate with the clients. So great tip. So this is super sort of open-ended. What's a fun life hack that you could share with listeners?
Sure. One thing that I've learned to love to do is I love to cook, barbecue. A lot of times my preparation has to deal with meat. I don't know why, but my wife actually bought me a cast iron skillet, and I've learned how to cook on a cast iron skillet. And what's great about a cast iron skillet is generally you only have one pot or dish to clean up at the end. Because you can do everything in the same pot and you only have one thing to clean up. It's really nice. But I've done fried chicken on it, steaks, I've done pot pies, bread, I've done cake in it. It's really fun to learn how to use it. And it's a multi-use tool. So I say, if you like to cook and like to, sear good steak, a cast iron skillet, especially for me, in Oregon, it rains a lot. So I can't necessarily go outside and barbecue because it's raining. I can use a cast iron skillet to cook a steak and sear it, put it in the oven to top it off. So that's something that I've learned. It's a really good life hack. It's so simple, but it's a really good tool to have around your house if you enjoy cooking and stuff like that.
A cast iron skillet. My mother would be so proud.
You can fry chicken in it too. It's great. It's really good.
Oh, you're taking me back to my youth, the cast iron skillet. So thank you for that tip. And thank you again, Warren, for joining me on the podcast today.
Okay.
And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.